Hi, and welcome to our end of June and our mid-year update for the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of the Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. All of the strategies in this book are easy to calculate and adjust each month. For those who are new to the concepts in this book, or for those who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this is a mid-year review. We'll be going through news of the month, review how the 20-month simple moving average system is doing, then we'll review how the MRI system is doing, then we'll review how the Dalio Portfolio is doing, and then I get to introduce a new system I've been looking at for more than 2 years now. And then we'll review the rules on dealing with a stock dip using what I call the 25% trailing stop loss system. And then, because this video is such a jam-packed video, we'll continue with the question of the month next month. So the news of the month. I finally launched my website, wealthydoctorinstitute.com. I understand that there are some sites which may still not recognize this site and may flag it, such as Facebook, but rest assured I did this website through a reputable website company called Wix.com. It took me a while to get all the I's dotted and T's crossed, but at least now it's live. So take a look at it. There's a very easy link there to contact me with any questions or just a separate appointment. Check it out. So the first system we'd like to review this month is the 20-month simple moving average system. The 20-month simple moving average system is a very basic system. It's just a one-rule system. Basically, if the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. In other words, this 20-month moving average is our safety belt. But as with any other safety system, it only works if we actually use it. In other words, it only works if we watch it every month. So before we look at how the 20-month moving average system has worked with the S&P 500 index, let's see how the S&P 500 index has performed so far this year. So if you take a look at how the S&P 500 index has performed since end of 2014, remember that in August we had that big whipsaw here in which we sold 1 month, then bought again the next month. That was painful. That made us deviate. And then in February, we had this 2-month whipsaw where for 2 months, the S&P 500 index was below the 20-month moving average and then went up again, and that made us drag again. So these regions are where the whipsaws occurred, and every system has its weak spots, and S&P 500 index 20-month moving average system has this one particular weak spot. Now this is why we only watch the S&P 500 index once per month. If you take a look at this chart, since end of April, this 2-month chart, you had Brexit vote. And of course, after the Brexit vote, there was this huge market reaction where it actually briefly dipped below the 20-month moving average for a day and then went up again the next day. For anyone who was watching this every day and was talking to me asking, what should we do, what should we do, this is why we watch only once per month. Otherwise, we get whipsawed a lot more often than we are. So how did the 20-month moving average do so far when we calculate out the 20-month moving average? Well, at the end of last month, the S&P 500 index fund, the VFI index that I use to calculate this, ended at 193.67 per share. Meanwhile, the 20-month moving average ended at 187.45. So to the math, we have a 3.3% cushion. Now, maybe we talked about this a couple years ago. 3.3% cushion is actually fairly relatively safe. It's not prone to whipsaws as much as other times, but obviously times have changed, at least temporarily, with all this uncertainty in the markets. Election year now, where markets can deviate 3, 4, 5% in one day. All we can do is, if you're sticking with this system, stick with this system. Watch it only once per month and make the appropriate transaction at that time. So here's what would have happened, backtesting, all the way back to 1986, if we were to compare buy, hold, and reinvest, the blue line, versus when the S&P 500 index goes below this magic red line 20-month moving average, we sell the S&P 500 index, buy a bond fund, and then when bond fund goes up here, the stock goes above the 20-month moving average, we switch back to stocks. When the stocks go below the 20-month moving average, we switch to bonds. And then when the stocks go above the 20-month moving average, we go back to stocks again. And here we saw another whipsaw here. Here's what happened with two whipsaws very close together. We take a look at numbers. The S&P 500 index fund is up 2.75% for this year, compared to our loss of 0.8% for our 20-month moving average system. Now remember, this is net of fees, so it was actually fairly flat this year. If we compare last 5 years, obviously with these whipsaws that really hurt us, the S&P 500 index, if you bought and held, you will have made 173% versus only 120% doing the system. However, if you go to 10 years, when we had a bear market to contend with, this is when it started to equalize. And in 20 years, we had two major bear markets. This is when our system really started to show its strength. So here are the numbers. If we compare the buy, hold, and reinvest column versus the 20-month moving average system, these are the years where we took losses, versus these are years when we took losses if we stuck with the buy, hold, and reinvest. So we take a look at the annualized return, 9.1% for buy, hold, and reinvest versus 10.5% for the 20-month moving average system, which translates to a 40% difference at the end of 30 years. So lessons of the month so far this year: no system is without risk. Every system has its weak spots. The 20-month moving average system's weak spots are the whipsaws, out one month in the next. But that's a relatively small price to pay to protect us from the larger bear markets, which is what this system is trying to optimize for. Next system is the monthly rotation investment system, what I abbreviate to the MRI system. This system is a little bit more complex in that instead of only 2 mutual funds, we rotate between 3 mutual funds: the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. The rule is, every month, rank these 3 funds in order of performance, and then sell the bottom 25% of your portfolio to buy that top fund. So if you do this, and there's a strong trend in one direction, eventually you will be holding only one fund after 4 months. So the monthly rotation investment system, if you take a look at these 3 funds, the blue for the S&P 500 Index Fund, the red for the Emerging Markets Fund, the green for the Inverse Fund, and here are the ticker symbols if you want to use the actual Vanguard mutual funds, and this one's RIDEX, or if you want to use a corresponding ETF, exchange traded fund, using these ticker symbols. So last month, the ending prices were here. This past month, the ending prices were here, and of course the S&P 500 index lost 1.6%. That's this blue line. This is despite Brexit. It did recover a little bit, but not quite as much as it did by the end of last month. The emerging markets, actually, even though there was a Brexit crash as well, it stayed pretty much above zero for the whole month and ended up this month 3.1%. The inverse fund, of course, if you lost in the S&P 500 index fund, you would gain a little bit in the inverse fund. So this month we have a clear winner, the emerging markets fund. So with the current MRI model, last month we were in 3/4 of our portfolio roughly index fund and 1/4 roughly in the emerging markets fund. If we were to sell 25% of our portfolio of the worst fund, which is the S&P 500 index fund, and use that to buy the emerging markets fund, we would now be roughly 50% emerging markets to index fund. So this would be our position for this month, and we'll revisit this again next month. So the MRI results to date, if you take a look at these curves, the blue line is the S&P 500 index fund, the red line is the emerging markets fund, and this green line is the inverse fund. If we do the MRI rotation, we get this purple line. You see how this purple line lags the S&P 500 index even during bull markets, and that's only because sometimes you have monthly partial whipsaws. But then again, when the markets crash, like here and here, we do not lose much. In fact, this is where we make money. Right now, yes, we've lost the last year and a half, but you see how last year the market conditions were just right for us to start taking consistent losses, whereas this year it's been pretty flat so far. So let's take a look at numbers. For year to date, the S&P 500 index is up 2.75%, whereas the MRI is really flat, 0.06%. I had to go that many decimal points to show whether or not it was positive or negative. And remember, this is after fees. If you take a look at 5 years, well, 5 years ago, 2011, it did go up a smidge, whereas the index fund went up. This was due to that year of 2015 working against us. But then if you take a look at 10 years since 2006, where there was a big bear market, there was no big bear market with our system, and we managed to make 212% versus 200% of just buy, hold, and reinvest. 20 years from 1995, where we mitigated 2 bear markets. The 2 bear markets dragged down the S&P 500 index, whereas with our system, we actually went up more. So here are the numbers. The S&P 500 index, buy, hold, and reinvest versus our system. And if you take a look at the losing years versus losing years of the stock market, you take a look at our annualized returns for stock market during this time was 9.1% versus MRI 11%, which translates to 45% more after 20 years. So again, lessons of the month. No system is without risk. Every system has its weak spots. The MRI weakness is during times of ambiguous trend, mini whipsaws become more frequent and starts to drag on our portfolio. So the MRI can detect longer multi-month trends and ignores very small cycle noise. However, if the cycles happen to have a period of around 0.5 to 1.5 cycles per month, that's when it catches the MRI. And that's what happened in 2015. That's not what happened in 2016 so far, knock on wood. I will continue to trade this system if you're in this system. Next system is the Dalio Portfolio. It's a pie chart. In other words, you buy a certain percentage of different asset classes and then just rebalance once a year to make sure that no one bear or bull market unbalances your portfolio. So the Dalio pie chart, as described in Tony Robbins' Money Master Game Book, it's based on this particular theory of portfolio management, which is different than what modern portfolio theory says. It's only dependent on two different factors for economic growth and inflation. How, just by rebalancing these particular asset classes, we can protect against these particular extremes of the economy. So the particular pie chart that is described in the book is 30% stocks, in which I use the S&P 500 index fund, 15% intermediate term treasuries, which I use the Vanguard VFITX fund, 40% long-term treasuries, which I use the Vanguard VUSTX long-term treasury fund, 7.5% gold, which I use the GLD gold ETF. If you want to hold physical gold somewhere, like in a safe somewhere, yeah, that's perfectly acceptable as well, as long as you know where they are. Don't hide it somewhere where you forget where it is later. And then 7.5% in commodities, which I use a DJP ETF to simulate in this backtesting. So how the numbers come out? Well, if you take a look at this year, the S&P 500 index is up 3.28%. The intermediate bonds is only up 5%. But look at long-term bonds, up 15%. Gold, up 24% last 6 months. The commodities, up 15% last 6 months. Now, annualized, they haven't changed much since our December video. And our weighted pie chart return for this past 6 months would have been 10.8%. Considering that last year we actually lost a little bit, this is very respectable. And an annualized return of 7.77% compared to stocks 8.69% over the same time period. And this is just highlighting the times when this strategy actually lost money. So far, knock on wood, it's never lost more than 5%. And as a result, the graph is extremely smooth compared to how volatile some of these other graphs are. So for instance, this blue line is the S&P 500 index fund. It does well over the long term compared to this pie chart, yes, but it also has these 50% drawdowns, which can really hurt, especially if you're retiring right at the peak. So this month I'd like to introduce one more system. This is SectorSurfer.com. It's also SomeGrowth.com. You can just type in SectorSurfer. As you can surmise, SectorSurfer is a trading or investing system based on sector rotation. Now, the systems I list in my book are modified from different systems I've encountered over the years. This is by no means an original concept. Many people have their own different sector rotation systems that work for them. And I first came across SectorSurfer around 2 years ago, just before my book was going to press. Now, when most people look at new systems, especially if they already have their own systems, they tend to look at it with a jaundiced eye. I like to keep an open mind. There are a lot of strategies out there that do not pass muster, but at least I want to test out the systems for myself and see where the weak spots are. For SectorSurfer, a couple of years ago, they had something called Stormguard, which was more complicated to calculate out than my 20-month moving average system and did about as well. So between the two systems, it just stuck with mine. And their sector rotation system, they tend to use a serially monogamous approach rather than only rotating a quarter of your portfolio every month. And this system is not a monthly system. It's whenever a signal happens to be generated. But what was striking about this system is that even though I've been following it for a couple years now, if you recall from video earlier this year where I remarked how the whipsaws that occurred in a 20-month moving average happened because we happen to have a perfect storm of the markets where it was sideways volatile, which, if there's no clear trend either way, can work against us. Well, guess what? Right? It wasn't just my weak spot, but it was also Stormguard's weak spot as well. So the author of this website, who happens to be a signal processing engineer, pretty amazing if you think about it, he, instead of just explaining away that, yeah, it's a weak spot, he actually wrote an improvement on his system. So to make a long story short, for those of you who get lost in geek speak, it's the 20-month moving average is a first order filter. It's just a filter to help us analyze data so we can detect an actionable signal. Well, SectorSurfer uses a third order filter, which is a little bit more complicated, but is more effective in trying to tease away more of the noise and get where the real signal is. So their whipsaws are less. So obviously I start to backtest this site now with not just my MRI and with my 20-month moving average systems, but with old portfolios that I used to use sector rotation on, and I've been pretty impressed. I've been looking, because I know the weak spots of some of these other systems that I've used before, I can look for these same weak spots in SectorSurfer, and I could not find these weak spots with this new Stormguard Armor algorithm. So that was pretty impressive. In fact, it was so impressive when I couldn't find these weak spots. And not saying that the system is perfect. No system is perfect. I'm sure there are weak spots along the way. That's why I will keep monitoring this, just like how I keep monitoring my old trading systems. But make no mistake, the system as it exists right now is pretty impressive, at least to me. And that's saying a lot. So for instance, when I use Stormguard Armor to flip between the S&P 500 index and bond fund, so in the system where we're flipping between the S&P 500 index fund and bonds based on how dangerous Stormguard Armor thinks the markets are, if the white line is the S&P 500 index fund, dividend reinvested, the yellow line is what happens when you flip between those two funds, and they trade approximately 1 to 2 times per year. It's not a monthly system, it's not unless you program it that way. But ideally, if it generates a signal once or twice a month and you place that trade, you can improve this line to this hypothetical yellow line. So if you take a look at how much return this has given us over the last 3 years, it's 12.8%. Over the last 10 to 28 years, 17%. And one thing I love about this site is that it tells us all these metrics. And I know that when I show people graphs, people's eyes glaze over, but I really have to show this. This is amazing. If you take a look at the probability of return per quarter, the white line is our bell curve of the S&P 500 index. But the yellow line, all we did was chop off this leg. That's it. This growth curve is identical here, but if we just chop off the likelihood of our loss and it just builds up a little bit here, that's all it takes to smooth out this line. That's beautiful. And we take a look at the backtested data, comparing the strategy to the S&P 500 index, year to date, 6 months, S&P 500 index returned 3.8%. This strategy returned 8.2%. And if you take a look at every single number in this column, not a single losing year. Now, I'm not promising that you'll never lose money with this. No one can promise that. But year over year, so far, over many different types of market conditions, including 2 different characteristic bear markets, this result impressed me. Now, let's say you have a 401k plan and you have a limited choice of mutual funds. You can't use stocks, you can't use ETFs, you're just stuck with mutual funds they give you. And in this particular example, I'm using America's Best 401k Plan, which is a mutual fund company that was described in Tony Robbins' book. A lot of us have read that book, might as well use that as an example. Based on the funds that they give us, we can be serially monogamous, investing in whichever fund is dominant, and at the same time use Stormguard Armor to protect us when times are particularly rough. And when we use those particular combinations of algorithms, back-tested data, last 3 years returns 14% to 20% over 10 to 22 years. Again, I'm not going to promise these types of returns. Again, there hasn't been a single losing year in the back-tested data. Doesn't mean that it can't happen in the future. In other words, it doesn't mean that we can't lose money in the future. But the fact that these algorithms has helped us avoid these bear markets so that the returns take care of themselves, that's huge and worth considering. So one other thing I love about this site is that it is a subscription site. I make no money promoting this site. I'm just describing what I see. The good news is you don't have to pay anything for this site. You can make your own portfolio sector rotation system, and it will give you back-tested data of which funds it bought and sold, which days, how long it held it for, what the returns were, and what the reference value is if you were to have theoretically invested $10,000 in the beginning. And it leaves out the one crucial piece of information, which is what is the system in right now. And it will tell you when you start subscribing. I think that's just genius, because then we can still analyze this to our heart's content and really prove to ourselves that this system has potential. And this is a very user-friendly portal. In other words, let's say that you made this portfolio of one stock and one bond fund. When there's a signal, it will email you, it will text you, however you want to set it up, and then when you make that trade, this button that would say acknowledge trade in red, you click on it and turn it into this green done button. So even if you happen to miss a signal, what I do is I log on once a week just to make sure I'm not missing any signals. And if I see a red signal, I make that trade on Monday and I click done. It's very easy. So the next system, just to go over, this is a 1% risk trailing stop system. This is a system that if you really want to buy a particular stock, limit your risk of that one stock to only 1% of your portfolio. I've seen people use half of their account or the whole account to buy one stock, and of course, they think the stock's going to the moon, and unfortunately, most times, these things crash. Maybe not immediately, but eventually. So if you limit your risk to just 1% of your portfolio, and if you were to use a 25% trailing stop loss order, in other words, if the stock drops 25% from the high, they automatically sell your stock. You can buy with up to 4% of your trading account this one stock, and you won't be risking more than 1%. Of course, it could be a little bit more. If a stock gaps down more than 25%, you're kind of stuck with a larger loss, but at least you have the seatbelt to protect you from catastrophic losses in general. And here's a nuance. If the stock goes up 33%, the stop loss is essentially at where you last bought the stock. In other words, if the stock goes up 33%, if it drops 25%, you're back at break even. Just like how if you lose 25%, you have to make 33% to break even. So if the stock goes up 33%, you can buy another block of stock using another 4% of your account, update your trailing stop loss order, and rinse and repeat until you finally stopped out. This way, if a stock really is going to the moon, you'll be buying more and more of it until you finally use your entire portfolio buying that stock, and you've limited your loss to just 1% of your initial portfolio. But if the stock crashes, at least that's all you lost. So the summary, remember, these are all different systems. Don't mix up these systems. Each system has its own rules. Don't mix up these rules. Don't make up rules. Don't disregard rules. Once you change the rules, you've changed the system. Or, if, more accurately speaking, once you change the rules, you have no system left. So remember, I went over several systems. Keep them separate. If you're using one system, stick to it until you finally quit. If you quit, completely sell out, and then go into another system if that's what you really want to do. But don't just combine systems. So we went over the 20-month moving average system. We went over the monthly rotation investment system. We touched base on how the Dalio Portfolio is doing this year. I introduced a new system or engine called SectorSurfer, particularly its Stormguard Armor system within SectorSurfer. And then I glossed over the basics of dealing with a stock tip. So for questions, keep those questions coming. I know I talk to several of you personally every month, but for those of you who have only heard about me indirectly, maybe you've got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Again, my website, wealthydoctorinstitute.com, is live now, so you don't have to use the Busy Doctor Investment Guide website to reach me. But seriously, drop me a line, give me a call, email me, set up a consult. A few of you who I've talked to, you know your stuff. I don't have to worry about you. But some of you that I've talked to, holy cow, it's clear you need help getting your financial life in order. For those of you who have been hesitating, don't be bashful reaching out for me. Don't be bashful reaching out for help in general. The more you delay, the more time is against you. So, until next month, invest safely.